Could one bad market swing or one bad financial decision derail your future? 5Q IQ Financial Power Ups with Trajan Wealth shows you how to protect yourself, and it starts right now. So, welcome to 5Q IQ Financial Power Ups from Trajan Wealth. I'm your host, Jeff Jr., with fiduciary advisors Marty Bryant and Corbett Leduc. We're tackling what happens if the market crashes right around retirement, the biggest estate planning mistakes that we see, confusing jumps in Medicare premiums, how taxes, investments, and estate planning all connect, and the questions you don't even know what to ask yet. If you're trying to protect both today and tomorrow, send us your questions at trajanwealth.com/5QIQ. So let's jump right in. And if you've ever thought, what if everything crashes right when I finally retire? You're really in good company because we've got some answers. Our first listener asks just that. What happens if the market crashes right before or right after I retire? Great question. Let's dig into it.
Great question.
You're screwed.
Nah.
Next question.
Yeah.
Next question.
And
Yep.
we're done. Go ahead.
Sequence returns.
Yeah.
That's a big part of that. That's really kind of that's the question behind the question. So where if you do retire and you have 3 bad years compared to if you retire and have 3 great years, if you're going to be taking out the same amount of money, let's just say $50,000, and you lose 10%, 15%,
You're talking about their
8%.
investment accounts. When
Right,
you
the
say
investment
you.
accounts,
Yeah,
right.
the investment accounts.
And you have all these losses on top of withdrawals, then you run a greater chance of running out of money, say when you're 90, compared to the inverse of that, where like you have 3 great years, the withdrawals are barely even impacting what your principal balance is, and then you have the bad years at the end, you're going to come out on the better end of that. No one can control that. But that's where working with fiduciary and being properly diversified with different investments across and within different needs of what you're trying to accomplish. If you're less worried about income compared to legacy assets, then those are 2 different scenarios of that. But, nobody wants a market crash, obviously. That's, all the people in cash, yay, I get to buy finally on the low. It's like, but you missed out on 40%.
If they're already in cash, they're not.
Yeah.
Yeah.
You
They're
missed
not
out on
buying.
40% for the last 3 years. Okay, good job.
Right.
No, that is meaningless, but to now that you think you're finally going to do it. But to your point, Jeff, most people are in cash. They're like, oh, the market's down now. I can invest now. Well, no, if you have a strategy to stay the course and have a level of risk that's comfortable for you, then everything will be okay.
Well, and it's not just a level of risk that you feel is comfortable, right? Because when we talk to people about risk, there are some people that say, oh, I'm conservative. But now if you go too conservative, you're running the risk of not even keeping up with inflation.
Which is high.
So
And has been.
that's where a fiduciary comes into play. And when we're using the scenario, we are doing all in an index fund, correlating it to the S&P 500. So what Corbett said, you have to be diversified even going into retirement, because there, again, you'll probably run out of money if you err on the side of too much caution.
Yeah, especially if you're doing like an all bond type of strategy, like, oh, I want to be safe. Well, great. That type of strategy has given you a negative real return for the last 5 years.
Yes.
And that will decimate any type of retirement plan that you got because you're being safe. I think one of the best things I got from Jeff when I first started at Trajan Wealth was, CDs. Basically you're going broke safely.
Certificates of disappointment is what we call them.
Yeah,
Yeah.
because, especially where we're at now on short-term rates, compared to what a 6-month CD is now compared to where it was 2 or 3 years ago, it's night and day. And the ability to make sure that, hey, am I doing enough to outpace inflation? Because, to your point, Marty, the 2 biggest things that most retirees forget about, taxes and inflation.
Yeah.
Yeah, I want to live on $100,000. Okay, that means you're going to really need about $120,000. Well, no, we got to pay for taxes and all those things for that to live on $100,000.
Unless they're fully Roth, and then we don't have to worry about it. But
Right,
we're not running into that.
Right, that takes years of planning.
It does. And it's all about planning.
Yeah, and make no mistake, though, a market crash just before retirement or just after retirement is going to hurt.
It is going to
But you
hurt.
have to make sure that you're properly diversified and you've accounted for that.
Right.
If we can have another source of income that you can live off of other than what was just in the stock market, which crashed,
Hmm.
then that's going to make the most sense.
What would that be,
Right.
Marty?
Well, maybe it could be an alternative type investment that's paying out consistently. Maybe it's an annuity that gives you guaranteed income for life.
Yes.
I think a lot of people make the mistake of just sticking with the plan that they've had 10 years ago or 20 years ago, and it's still in their 401k, and that's what they've stuck with. So in that case, if you're way too aggressive, it can really hurt. In 2008, we've seen it. Even 2020, we've seen it where people's retirement really gets derailed because they lost too much. They really have to go back to work. So great question. Next, we're going to shift from market timing to the mistakes that quietly undo good plans. Our next listener asks, what are the biggest estate planning mistakes that you typically see? So let's discuss that. Great question.
I mean, I think the biggest thing is not having a plan. That's obviously the easiest and most obvious one. But within that plan, how complicated do you need a trust? Because trusts don't have to be complicated, but the ability to make sure that you're avoiding probate and having a plan, or what I'll kind of say that power beyond the grave, and knowing that, hey, for me, I've got 2 kids, 19 and 13. I know that if I didn't have a properly structured trust and something happened to me, the trust is going to dictate that they get the first third at age 30. They're going to get the second chunk at 35, and hopefully by age 40, they've developed the financial acumen to not blow it on European vacations and jet skis. So making sure that you have those plans in place that don't derail something that can really, just leave you devastated for that.
Right. So controlling the assets from the grave is in essence what a trust does. Now, for the people who don't have anything like that in place right now, obviously we would prefer that you do reach out and see what you do need to protect your legacy, if that's important to you. If you don't care about keeping everything private and you don't care about the devastation that you're causing by not having a plan, then don't do anything.
Especially for my kids, if they get all these assets at 19 and 13, I mean, it could ruin them.
Right. But at the same time, for maybe people who aren't in that position of all these assets, right, you can simply just make sure that you have beneficiary designations on accounts. You can also put a beneficiary deed on your house.
Yeah, but that's not going to protect them from if they get too
It's
much
not
money
going
at
to
once.
protect probate, but
It's
those
a start.
beneficiary-
It's going to protect probate, but it's not going to protect from ruining the kids possibly.
No, it won't. But at least you've done something. Right? There's something there.
Baby steps.
Baby steps. And I'd rather see you take those little steps than feel overwhelmed how daunting even contacting an estate planning attorney would be, which, here at the family office of Trajan Wealth, we have that in-house. And you don't have to be a wealth management client or even a tax client in order to access our estate planning.
Another big
So-
mistake that I see is a lot of people confuse a will and a trust, and they think that a will is enough. And one thing that we've known for a long time, obviously, is a will doesn't avoid probate, whereas a trust will. So that's a huge mistake that we see quite frequently, where people just misunderstand
Right.
what a will
I thought I did
does.
the right thing, and then
Right.
And intent does not trump the law.
Right.
Yeah, unfortunately.
So let's talk about something that shocks a lot of retirees, which is health costs. One of our listeners writes, why did Medicare premiums go up so darn much? That is a good question. I didn't personally experience it, not there yet, but so why did they go up so much?
We'll let Marty start because she's the oldest.
Thank you. And the wisest, too.
Mm.
Yeah, that's okay, Corbett. One day. So, and again, it can depend on your personal situation. So if that question is in relation to, did she just retire? Is that what she's correlating that to? A lot of times what we see is, now, so I'm going to back up a little bit. Medicare premiums are based on your prior 2 years tax returns, right? So they do a look back.
Right, depending upon how much that income is, not baseline.
No, it's your AGI. So what your AGI was when normally it's going to be looking back and you're still working at that time. So if, let's say, you retired and you cashed out your
Vacation, stock
your
options.
vacation, your sick pay, things that are one-offs, not a normal tax year for you, that can inadvertently push up your Medicare premiums.
What is that called?
Why don't you go ahead? It's IRMAA. Why don't you go ahead and give us what that an acronym is? What, Corbett? You're not the most intelligent person here?
Income
Redu-
related medical associated.
Adjusted.
Adjusted, yeah. Okay.
Adjusted.
Anyway,
Anyways.
so Irma, so there are calculations that are done. Again, it's our government.
Right, based on your
Anytime the
AGI.
spider web is involved, we know that taxes are going to go up most likely, or you're going to get hit somewhere.
Spiderweb?
Our tax code, our government is a spider web of different assessments and calculations and taxes. And every time you turn around, something is there that you might not have thought about. And that's why it's important, again, reach out. Reach out to a fiduciary. That's what we're here to do, is help you navigate those waters. What is that going to do to your tax picture
Right.
if you do cash out? Can we possibly cash out something between December of one year and January of the next year?
Right.
So that you're not taking a huge
Spread out over 2 tax years.
So that you're not taking, a huge income assessment in 1 year. Spread it out a little bit.
Yeah, if you've seen a jump, more than likely it has to do with Irma.
Right.
Yeah.
If it's a dramatic jump.
Yeah.
A dramatic jump, which is income-related monthly adjusted amount.
Yes.
So they're going to look at your previous 2 years' tax returns. But the important thing to note about Irma, too, is you can appeal it.
Right.
And in many cases, they do grant you an appeal. In a few cases, specifically retirement, marriage, divorce, death of spouse, and loss of income is where they'll appeal that, so your Medicare, your premiums don't go up so much.
So again, take into account if you're deciding to sell a second home, highly appreciated asset, things like that. We have to have these conversations.
Roth conversions.
Roth conversions. That's
Roth conversions,
I
yeah,
didn't
good
bring
point.
up Roth conversions because we are going to talk about that.
Now, this next question, how do taxes, investments, and estate planning all connect, is such a good question.
So they are all intertwined, I guess is the right word I think I was searching for earlier. Intertwined in that your taxes are hinging upon your income, your taxable income levels. Your estate planning is going to help pass your assets along when you pass away. You're going to have a final tax return for your estate. You will have a final tax return for your personal.
Do you know the number on that final return?
Do I know the number?
The form?
Oh, I thought you meant like the dollar amount. I could tell you yours here really shortly, but what is it, Corbett?
706.
706. Perfect.
Do you know how you remember that?
How?
Because it's your final tax return when you're 6 feet under. 706.
Well, where does the
Jeez.
7 come into play?
I don't know. I just remember that from CFP.
Oh, we all know can't frickin' produce, but that's okay. So anyway, so back to the questions. So they are intertwined together. Your estate plan is going to be obviously extremely important when you do pass away. And that's where that transfer of wealth is going to happen, is going to be through that estate plan. So I don't know what else we want to.
I mean, the investment part, certainly depend upon how the investments are in what type of accounts. IRA accounts compared
Registrations.
to broker accounts. Registrations, thank you.
Yeah.
But also same thing with the qualified accounts, IRA accounts, is it Roth IRA or is it traditional IRA? If you've got more assets in Roth, then fantastic.
Yeah.
Then we don't have to worry about RMDs later on, which leads to the tax questions and all those different things that come into play. Because, in fact, I had a client just yesterday, good amount of money, and he had probably at least 3/4 of his assets in tax-free mutual funds. And he's in the 12% bracket. And I'm like, Joe, this is not really benefiting to you, and his advisor was a fraternity brother of his.
Broker.
And he's been with him forever. Broker, exactly right. But the same thing is like, okay, yes, municipal bonds are great if you're in a high tax bracket. If you're in the 12% bracket, then, you're leaving money on the table.
Yeah.
Luckily I was able to say, hey, I get it. You might pay more in taxes, but your overall return, because his target was for $150,000 a year of income. We can do that. You might pay a little bit more in taxes, but you can have a better return.
Now, the other cool thing, when somebody does die, I know it's never cool. You don't think
That
it's
would be
cool
really
when
cool
somebody
for-
dies,
that would
but
be- It would be
thing,
cool
not-
for you,
not the
though.
death,
but
the thing.
if
'Cause
I
I would be happy.
died, oh no, you wouldn't. See, now you're killing me
Oh,
again,
Corbett would be
Stop
sad. Yeah,
killing
he's-
me.
Corbett would
But
be sad.
on
Who you trying
appreciated
to fool?
on appreciated assets such as a home or stocks that are sitting in an individual or a trust account, what gets to happen for the beneficiaries is something called a step up in basis, or even if somebody owns a business. the person who's inheriting those assets are going to inherit it at that current market value as of the date the person passes away.
Right. Or a valuation of 6 months later.
Or however they want to do the valuation, and when it's happening is going to bring it up to that step up in basis. So that's a benefit. And that's one thing that we also talk about with our clients is do not put your children on your bank accounts. Do not put them on your house
Right.
because you're giving away the tax benefits that they're going to have when you do pass away.
But I go back to the original question, which is how do taxes, estate, and wealth all work together?
So-
And they're not just combined. They're just not.
Right.
They're intimately combined.
Yeah.
Right. And
And
you
that's
have a
really-
strategy for each.
And you have to have a strategy for each. And
Mhm.
really, that's the premise of Trajan Wealth and the family office and
Yeah.
the all under one roof, because they work very closely together. I was actually speaking to somebody else's client the other day, and they said, I've got a CPA that I talk to once a year when he does the preparation. So there's no planning. It's
No
just
planning.
preparation.
Yep.
I've got an advisor that I talk to every now and again. And then I don't even have an estate attorney. So there's a big gap within this plan. And that's really the premise of Trajan Wealth and the family office, all under the same roof, communicating, talking, working together.
Especially if the spouse is not involved.
Yes.
That's the biggest thing where you have one person to call. Yep, I can call Trajan Wealth. They've got all those three things covered on that part compared to not even knowing who to call, where to call, making it simpler to have your spouse taken care of. Because, no one would want to, maybe my ex-spouse, that'd be a different story. But the ability to, have someone you've loved for 50 years and just to be completely lost when she's already blindsided on something.
Within a relationship, one person handles the finances.
Typically, yeah.
Always.
Right.
It's the first
That's
person
just
who
the way it
balances
works.
the checkbook after
Right.
they get married.
Right.
You're in charge.
Right.
Yeah.
Yep. Great question. Now, if your financial life feels like separate buckets instead of one plan, you're not alone. Millions of people in this country feel that way. All you have to do is send your questions to trajanwealth.com/5QIQ. And if you want to get a little bit more detailed, simply contact Trajan Wealth. We do have wealth management, estate, and tax all under one roof, and we would be very happy to help. Let's finish with the question that a lot of thoughtful people ask, and they eventually land on all the time, which is, what questions should I be asking about my financial future? If you ever had the sense that there's a whole layer that you're missing, this one question is for you. So with that in mind, what question should they be asking?
The question they should not be asking is, do I get my best information from TikTok?
And you
And a lot of people do.
Yeah, I literally,
Yep.
I have a prospect that I've been working with the last couple of days, actually a local lottery winner, and he sent me a picture of, this is what I want to look at, and it was parking his fiat dollars into Bitcoin from TikTok. And I was like, oh boy, what question do I need to ask?
Am I prepared for long-term care? What is in my plan for long-term care?
Right. And for a lot of people, by the time they start thinking about it, it's already too late.
Mhm.
You know what I mean?
But I would say in his defense, go back to this guy who looks on TikTok. His view is, I need to find an unbiased source.
Right.
And that's TikTok. When they look at you or us, we're biased.
Right.
We have an agenda. So what do you say about that?
Mhm.
Well, that's a good question. It's just a matter of depending upon who's giving that information. That's my biggest
Qualifications.
problem with TikTok. Is like, if you've got someone who thinks
Mhm.
they know something
Mhm.
and they're spreading bad information,
Mhm.
and yeah, it might be independent, but it might be independently bad.
Here's a fun way to ask a question. Who is going to change my light bulbs? Who's going to change my light bulbs when I'm aging and I'm old?
Handyman.
Who is going to be
Next
taking
question.
care of me? What if you can't afford it?
If
How
you
are we
can't
gonna-
afford a handyman,
If I
then
want a handyman to come in and change my light bulbs while I'm still living in my home, how do I set myself up to be able to stay in my own house? Am I prepared to do that?
yeah, very good point. I hope you bought a single level home.
Or you can get the motorized chair.
Yeah, that's true.
Go up So those kind of questions, and I think most people don't ask them.
And I'd say just go with your gut. What are you feeling?
Right.
Ask the questions and make sure that you understand the answers that you're getting. I've seen
Right.
too often in this industry, financial advisors really try to confuse you with jargon.
Yeah.
They baffle you with BS.
Mhm.
And a lot of people go with that and they don't dig in and they don't go with their gut. So if you are looking for a financial advisor, make sure that fiduciary advisor, obviously make sure that you're
Hearts of
talking
teachers.
to a couple of them And who do you feel good with? Who's answering your questions? Who's being
Mm.
straight with you? And also, don't trust everything that you see online. You could use online to gather information. You could even use AI to say, what question should I ask a financial advisor? Nothing wrong with that. But don't believe all of the stuff that you see online, back to Corbett's point. So great discussion, great topic. So today we looked at what happens if markets crash at the worst time, the estate mistakes that undo good intentions, surprise jumps in Medicare premiums we discussed, how taxes, investments, and estate planning all fit together, and the questions beneath the questions. So, which part of your story still feels unclear? Let us know at trajanwealth.com/5QIQ and share this with someone who's worried about getting one big thing wrong. There are lots of people out there like that. So plan smarter, dream bigger. One clearer step toward a future you can trust and a present that you can enjoy. And that's really the goal. So thanks for joining 5QIQ Financial Power-Ups with Trajan Wealth. And if you have any additional questions, or heck, if you want to just schedule an appointment, please do with Trajan Wealth. We'll see you all again next week.